The most common thing I see working with federal employees is the whole program is do it yourself. The only guidance that anybody gets is either from the coworker at the water cooler or from the internet, right? So that's what they're basing the whole financial future. And a lot of federal employees, because of the nature of the plan, they will match dollar for dollar up to 3%. So what does that simply mean? You got to match 5%, right?
Yeah.
100% return. You got to do the 5%. So a lot of people don't do that.
Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Tall Oaks Podcast. I'm your host, Branden DuCharme. Today I am joined by a guest, Trevor Trebbien with Encompass. And Trevor has a unique experience at working with federal employees and navigating their retirement planning. And it's a little bit more of a unique space than people oftentimes think, right? The initial thought is, hey, like you work for the federal government, like I got a pension, you know, what more do I have to worry about with retirement? And there's a lot more, right? As with any
There's a whole lot more. There's a lot of levers to pull. So thanks for having me on today, Branden. So yeah, with working with federal employees or a federal employee starting out, there's a lot of unique things. The most common thing I see working with federal employees is the whole program is do it yourself.
Yeah.
Right? The only guidance that anybody gets is either from the coworker at the water cooler or from the internet, right? So that's what they're basing the whole financial future. And a lot of federal employees, because of the nature of the plan that it has a pension, usually do the time in the plan to see it through. So just pulling a couple levers and understanding the plan on simple terms is really important. The difference from being successful and setting themselves up for a good retirement, or like when they reach out to me when they're getting close to retirement and scrambling, trying to pull these levers.
Yeah, you know, a common thing we talk about in the podcast is that idea of like planning probably starts a lot sooner than people normally think. And I suspect we'll probably get into some understanding why. People on the federal retirement system, right, or federal employees, they have a specific retirement pension plan. What's that normally called?
Yeah, it's called FERS. It's Federal Employees Retirement System. That's exactly what it is, and that's one component of it.
That's the pension.
That's the pension portion of it.
Okay.
Right? And then obviously they get Social Security, and then they have another aspect that acts like a 401k. It's called a TSP. Same with military. Military gets a TSP as well.
Okay. So the pension, really quick, give a quick overview of how that's calculated. Is it?
Yeah. So the pension, it's based on time, right? Okay. It's a really unique pension. So the cool thing about FERS is they have a minimum retirement age. The actual minimum retirement age is 57. Okay. To qualify for the pension, you have to at least put in a set period of time. The golden area where you go in there is at least age 57 and 20 years.
Okay. Right.
The calculation that it has, it takes something of the salary. If they take their salary, they have their last 3 years of working. Mm-hmm. They call it their high three, and they'll calculate that on an average, and then they'll put in the formula for that, and that'll be their pension. And then it goes up and down depending on the years of service they have and how long they work. Obviously, their salary, and there's other things such as locality, meaning if somebody is going to be working in Orem, Utah versus the Bay Area and San Francisco for the same job, the salary is going to be a little bit different.
So they adjust you up or down accordingly on some kind of index calculation.
Exactly, for locality and the type of work you're doing.
Okay. So that's the part that most people like. I think that's the stability to the plan, right? Like to me, that's the part where people usually go, hey, okay, I'm going to retire. I'm going to get 60%. You know, if I work for 30 years, I think it's about 60%, right, of their base.
It's kind of, well, what they do is you look at it, if you take somebody with $100,000 salary, I believe it's at 20 years, it's 1%, right? What? So is the calculation, but it works out to somebody with $100,000 salary. On the high three, they get about $2,000 a month in a pension.
Yeah, $24,000 a year. Mm-hmm. Okay, so on just over 1% of your base per year of service, right?
You got it.
Okay. So certainly a different calculation than like military pensions, which, you know, I'm a little bit more familiar with from my time in the Army. that's the part though where, again, going back to the stability, right? It's predictable, and somebody can say, okay, well, like if I retire at age 60, I will have worked here for so many years. My pay is now X, and I get an annual increase. So, 9 years from now, my pay should be X. My highest the average of my highest 3 years should be X, right? It's very predictable. And oftentimes what I've, found, and this isn't exclusive to the federal employee space, but in general, people with a pension, they tend to say, okay, I'm going to get this much from Social Security, this much from pension, and that covers so much of my normal paycheck. So I got to figure out how to just pay the car off, pay the mortgage off, and I'll be okay to retire, right? Like that's all of a sudden that's the most thought that goes into it, and that's a really good starting point for a lot of people, right? The second component that they have, though, that sometimes gets overlooked is this TSP, right?
Yeah, and the TSP, because it is really designed to be the three-legged stool between the Social Security, FERS, and the pension, right? And that to really be like your liquidity bucket, right? And there's some things in there in the plan that are really simple. Again, it's do it yourself. So unless they have the right advice of knowing how to allocate into the fund, which is very simple, and pull a couple levers, it can underperform. And one of the biggest things is the match. So on the match, they will match dollar for dollar up to 3%, right? So if you do 1%, they do 1%. You do 3%, they do 3%. But after 3%, it's only 50 cents on the dollar up to 5%. So what does that simply mean? You got to match 5%, right?
Yeah.
100% return. You got to do the 5%. So a lot of people don't do that. That's the number one thing.
80% return. So if you're on the TSP, right? Which for like simplification purposes, it's just like it's a federal government 401k plan.
Yeah,
right?
that's all it is.
Obviously, there's some technical, like very, very deep in the weeds technical differences, but it's your workplace retirement plan provided by the federal government, right?
Right,
TSP,
absolutely.
Thrift Savings Plan. And what you're clarifying here is, if you put in 5%, they're going to put in 4%.
No, 5% match. So they'll match 5% up to 5%. But if you don't do if you do 3%,
Trevor, you got to keep your story straight here, man.
Yeah, I know, right? Exactly.
3%, they match dollar for dollar.
Yeah,
and then 50 cents on the dollar.
It has a gap, right? And then at 5%, it matches the whole thing. So.
Oh, really?
Yeah.
Okay, so that's unique. Like that's different than most 401ks.
Exactly, and that's where people get tripped up.
Okay.
Right, because maybe they're wondering about the withholding that's going on, and they're just starting out, and they don't want to do that big of a withholding. You just got to do it. Just do the 5%.
So if you do 5% contribution, you get a 5% match.
You get a 5% match.
Yeah, that's pretty good. That's better than a lot of companies' 401k plans.
Yeah, absolutely.
What I mean? In the private sector. So what's unique about the TSP though is also like the allocation, and you mentioned that a little bit, right?
Yeah, the allocation is really simple, right? So it's managed by BlackRock. Everybody knows who BlackRock is. So I'm assuming they're doing a good job. Hopefully, right?
Potato on that.
Yeah,
I think jokingly people know who they are because they always complain that BlackRock owns the whole world. And just what I'm going to highlight.
They also own the TSP.
Well, I'm going to highlight what's really quick is, hey, BlackRock manages a TSP, or BlackRock manages those index funds that everyone has in their 401ks or in their IRAs or in their brokerage accounts or their Robinhoods, right? Mm-hmm. And so you're buying a BlackRock index fund, and so you actually own the whole world, right? Us as the public, we own the whole world. BlackRock is the one that they have the filing that says, hey, we're the majority, or we're a significant shareholder of this corporation, but it's by way of the fund that you're the owner of the fund, right? So it's just an entity, but you're the owner of the entity that's showing up on the filings, right? So, BlackRock, potato on, whether or not they're doing a good job, jury's still out on that. But they are a big, well-known entity, and that's how it works. Just a quick reminder. So BlackRock manages a fund, but you own the funds, right?
You own the funds. You own the units. They're kind of like a mutual fund, but they're not, right? So there's 5 funds. Okay. G is the government bond fund, right? That's the low-performing one. That's considered the safe fund. They have what's called F. That's the Bloomberg Bond Aggregate Fund, right? Bloomberg. We always say get the F out of it. That's what F means for it. And then then there's S. That's the S&P 500. Okay. There's the there's the S is the God, no, I'm drawing a blank on there. The C is the S&P 500.
Sure.
The S is the Dow Jones, and the I is the international.
Okay.
Right. So you have your 3 are basically your equities, and you have your 2 that are considered your safe bond type lake funds. So 5 total funds.
So G fund is like your kind of like a money market, similar idea, right? Short-term treasuries probably.
Yeah, 10-year treasury.
Oh, it's a 10-year treasury?
Yeah. We were just talking about that.
Whew. I'd say G is get the heck out while you can too on that potentially.
Historically,
no, everyone's, hey, listen, on a real note, everyone's got their own objectives. That's totally a sarcastic joke. But, I think what I want to highlight really quick is like, those are all really simplistic ideas. And simple doesn't mean bad, right? Like simple doesn't inherently mean bad or wrong when it comes to investing. So if a 10-year treasury, if that lines up with your goals, objectives, and risk capacities, like G funds for you, right? Like if you want a little bit more, potential return over time, like the U.S. Ag has, typically done better than 10-year treasury, right? And it's because it's going to pick up a little bit more of that investment grade corporate bonds. U.S. Ag is going to pick up, mortgage-backed securities, right? And so mortgage bonds, although they get a bad rap from, 2008, like they do typically pay a little bit higher of a yield than like a 10-year treasury would because of the embedded options from the mortgage contract itself, right? So U.S. Ag can perform even a little bit more, but can take on a little bit more volatility. Certainly, so you're taking on some credit risk. In addition, you're taking on the reinvestment risk on the mortgage bonds. So there's some different components to it. Then you go, okay, step further. So you're saying the S fund is the Dow Jones.
Exactly.
Okay, been around a long time. Some people say it's the most important, index in the world. It's what gave birth to the Dow theory. Obviously, so you have 30 of the largest kind of industrial stocks in the U.S. Again, now you got a low cost, way to access that. A little bit more value oriented is what I'm going to just highlight for people that are listening to this and thinking like, well, how do I allocate or how do I think about the world? The Dow has typically underperformed the S&P 500, especially the last, several years. However, it tends to be more value oriented. So you can actually see in the markets when times when value outperforms, typically is actually when the Dow is maybe outperforming the S&P, right?
Right.
So, not necessarily good, bad, right, or wrong. Just it is what it is, and it's different. It's an option. S&P 500, look, everyone knows what the S&P 500 is, right? Mm-hmm. 500 of, from among the largest companies in the U.S. that are at least at some point were profitable,
right.
When they got included in the index. It's market cap weighted, which is very distinctly different than Dow Jones, right? So Dow Jones is price weighted. So actually the price of the stock is what's going to determine the weighting in the Dow Jones, which is kind of goofy, but it was the original way of market cap weighting, right? Mm-hmm. Back when, we didn't do an unlimited number of stock splits and reverse splits and all this stuff to really manage the price of a stock. And so the theory originally was the bigger the stock price, kind of the bigger the company, right?
Right.
But they've never changed that methodology. So the Dow is weighted differently than the S&P. S&P is actually float adjusted market cap weighted. And then the last is the international. I don't know what index offhand they are.
So you're going to make me have to remember this, right? I have some proxies for them.
There's a million different international indexes.
Yeah, there's a couple proxies, but I mean, as far as you look at the plan, it's been ripping the last couple of years.
Well, yes. So let me add some context to that. Okay, valuation internationally had gotten really cheap, and then the dollar was a bit extended in 24. Okay, mm-hmm. So when you invest internationally, there's 2 things that you're taking on that you got to be aware of. Right. So the first one is like the business risk, right? So whether or not the companies do good, right? And that's a risk that we normally think of when we're investing here in the U.S. in our own local currency, which is like, hey, is Apple going to have good sales, right? Is Google going to keep performing? Is
Amazon keep performing?
Is Amazon going to keep selling packages? Are people going to keep buying Microsoft? Right? Like, is this economic activity going to continue, and are they going to grow earnings and profits? Right? So you take that risk on internationally, right? Is if you're investing in Germany, is SAP Web going to be
Coupang?
You know what I mean?
Are you familiar with Coupang?
No,
it's the Amazon of Korea.
Okay, Coupang, yeah, Alibaba.
Yeah, there you go.
You know what I mean? And so you're wondering, hey, are they still going to produce oil and gas up in Norway, right? Like, mm-hmm. And are they going to do that at a profit? Okay, you're taking that risk on. Now, the important thing and what adds diversification to a portfolio potentially for international and the case for or against it largely is often less about that business risk and more about the U.S. dollar, right? The currency exchange. So if you invest in international, and we perceive all of our accounts in U.S. dollar terms, right? It's the currency we live in here in the United States. If the businesses in Norway are doing great because it's oil and gas right now, baby, and that is a huge part of their economy, right? Up in the Nordic states there, okay, and they're producing a ton of profit. Good investment, right?
Right.
Okay.
Correct.
However,
except for the dollar exchange, right?
Yeah. If the dollar strengthens relative to the local currency, you might not actually make any money on that investment in terms of U.S. dollars, right?
Yeah,
your U.S. dollar returns, which is what matters to us here in the U.S., right?
Yeah.
And so we've seen that post 08 where there was this huge underperformance international. No one really wanted it, right? It was very unloved. And it's because the dollar was getting stronger, right? So you could go and look and say, hey, great company, great economy, great fundamentals. But because the monetary policy differentials of the central banks, right, and the U.S. dollar being that reserve currency of the world, it was a really big headwind for international. So last year, you saw the dollar absolutely get hammered. It was the worst year in history for the dollar. And international, surprise, surprise, had a great year, right? Hey, also, so did the other, international asset that is pegged against dollar, right, which is gold.
Right.
So if you want to look at it, I kind of say, hey, if you want to isolate, is international actually good, or am I just getting a leveraged dollar trade? You really got to look at is international outperforming gold in some context, right?
Yeah, we were just talking about gold earlier.
Yeah. Which hey, look, last year gold way outperformed international stocks, and this year international stocks are way outperforming gold, right? So there's obviously a case to be made for probably both, right? I always say the genius of and. It's not gold or stocks or international or U.S. domestic. It's domestic and international. It's stocks and gold. It's right. But you do have to think about that when you're allocating to international, right? So you want to take a big bet on the dollar being a crappy currency. You can allocate your whole TSP to the I fund.
Yeah, the I fund's been ripping.
Probably not a good idea though.
I don't recommend it, and that's the problem. Like people don't have the advice, and they see that it's an emotional reaction.
Yeah. So you got to understand, and you don't want to chase, right? You don't want to get in your TSP and start saying, hey, what's performed really good lately, and start making changes, right? It's kind of a bad idea. Yep. Actually, it's not kind of. It's a really bad idea.
Exactly. So there's two more components to it as well. There's also a mutual fund window. It's very limited because they do look at the fees in the mutual funds for the loads in there. They only approve one. So obviously like a high fee mutual fund, a high load mutual fund won't make it in the window. And then you as the participant, that's what you're called. You're trading it on your own. Really, There's no advice. Hey, yeah, I could talk to Branden and say, hey, what mutual fund do you think I should come in here? But there is a fee to it. Where in the 5 funds, there's no fee.
There's no fee.
There's no fee in they're very low cost, very low expense ratio. Okay. We were talking like under
nearly
3
free.
Basis points, basically free, right?
Just like any other good old index fund.
Yeah.
Okay. Is there somewhere that people can find that list of mutual funds in the mutual fund window?
Yeah. If you just go to tsp.gov, it listed in there for the mutual fund window. You can look in there. Obviously, you have to be a participant to see what's listed in there active, but they give all the historicals, where it's at year to date, that sort of thing in the fund as well. And then the last component of it on there is something called the life cycle fund, right? So it's just really your traditional,
it's a target date fund.
It's a target date fund. That's all it is. And for people that don't know how to use the TSP, this is what I've heard from my federal employees. They'll be talking to somebody and say, I was all in the C fund. Now I'm a TSP millionaire. It ripped. So maybe they got through 2008. Maybe they got through 2000 and the timing was right. Okay, so what we don't want to do is get into the wrong timing. So a lot of people, what they do is they get overly cautious and they don't know what to do, and they move it all to the G fund, which is okay. They're going to be cautious, but then they leave the opportunity cost on the table.
I don't know. That's actually okay. If you understand bond math, it's not as cautious as you're hoping for.
But from the retail side, just the
mindset.
the federal
the mindset
employee,
is
I don't want to lose anything. This is my money. I did my 5% match. I know Branden had it all in the C fund, and he could take more risk. He went through 2008. I can't deal with that, right?
Yep.
So they have the life cycle fund that is really simple to be set up, and it works well for people that are do it themselves selfers because they can look at the risk. Yes, so they might retire in 5 years, but if you want more risk, do the longer duration, right?
Yeah.
So, and it turns out to be a 60-40, 50-50, and then the last one in the retirement, they call it the L income, and that's inverted, where it's 70% into the bonds and 30% in the equities.
Yeah. I gotta be candid. I don't love any of these. I'd be interested to see that mutual fund list, see what else is out there.
Right.
But anyways, okay, so you got the TSP, look, you got to make the best of what you do, best of what you can. One of the things that I try to remind people when they're talking about like, hey, usually they're saying, people will say like, oh, 401ks are a scam, right? And so now a lot of videos on TSPs are scams, but the same concept of what would make them a scam, right? And they're not, newsflash. But you could look at the TSP options and say, man, all those investment options are suboptimal. I don't really like any of them. It's like, yeah, but if you're getting 100% rate of return, you're doubling your money on day one, you can have pretty mediocre results after that and still end up with a great average return.
Yeah, you just got to be disciplined, just like anything.
Yeah, so, still utilize it. Okay, last thing, like what are the major, for lack of better terms here, like landmines that people run into? Like what are the things that people come into that are major friction points as a federal employee? Hey, like I know I've got the pension. Hey, I diligently put some money away in the TSP. I did okay. Now what? What are they missing?
Yeah, so I'll give you two part. There's also on the opposite of the landmine is, landing in a bag of gold. And so that's part that I didn't bring in there. I know you're former military. In the federal employee system, you can buy your military time back. Did you know that? Have you heard of anybody doing that? Going from military and going into civilian?
Not familiar.
Okay. So for the time that you did in the service, you could take that time and roll into a federal employee job, and you can buy back that military time. So if you're trying to shoot for, say, 20 years of service and you have 10 years military, guess what? You can buy back as an allotment into the paycheck 10 years in there, and you only have 10 more years you have to work, and they'll give you 20 years of credit towards the pension. So why am I bringing that up? So you're circling up the landmines. That's one of them, putting in the proper amount of time and really getting a good estimate and understanding in the pension. What is it going to pay? Mm-hmm. Right? And then obviously the Social Security conversation. There are mechanics in the TSP if you do early retirement. I had a client that started with the federal government at Indian Health Service right out of high school. That's a federal job, right? So she was 18. She was 55, 56, had 30 years of service in, already had $1 million in her TSP. In here, they have an early retirement part where you can, at 57, plus, I forget if it's 20 or 30 years on there, but you can get a supplemental 2-year Social Security before you retire. They'll give you 75% of what your Social Security would be at age 62 to bridge that gap before you can take Social Security. So Social Security is important, how we time it and where we put it in there. Are you going to use the supplement? Do some good income planning. This is where we come in, right? Where we can bridge those gaps to really look at the gap in between what are you going to be, what are you making now, right? What's life going to look like if you're a single income household or a dual income household? When do you take Social Security? And then obviously in the TSP, should we start taking withdrawals out of it now to bring that down later on against the RMDs? So we're just not building it the whole time? Or is it a glorified savings account where we need to maybe make some moves before that? Maybe do Roth conversions, which they do have a Roth conversion plan inside there of this year. However, caveat, right? They don't withhold the taxes. So
it's actually a positive, it's actually positive. When you do a Roth conversion, you don't want to withhold the taxes from the IRA, or in this case, the traditional, just whatever the traditional funds are. You want to pay those taxes from outside the ecosystem, and so inconvenient policy for some people, sure, the right thing to do, probably, but that's a new option, right? So one of the things I'll just remind everyone is, look, if you started 20 years ago putting money in a TSP, it's all traditional, right? And so it's not uncommon that people have...
Yeah, it's all tax deferred.
Yeah, so people have the large tax deferred balance, and all of a sudden they go to you say, well, I'm going to retire early, right? And I'm going to retire whether it's at 55 or 62 or 64, excuse me. There's probably this window where it's like, hey, you haven't filed for Social Security yet. You have all this money in your tax deferred bucket. you don't have a massive lifestyle. You don't have bills anymore. The mortgage paid off, cars are paid off, whatever, right? And your income effectively goes to zero. You still have a standard deduction, right? So if you're married, that's like 32,000, right? And then you've got the 10 and the 12% bracket to fill up. And so all of a sudden you go like, you could convert a lot of that money over the course of just a couple of years and really bring down the RMD later in life. So that you're taking money out in the 0, the 10, and the 12%, effective buckets, and you're minimizing how much you're taking out later in life in the 22, 24, 30,
Exactly.
34 bucket.
You don't want to ever be pressured into it to where you get stuck perpetually by IRMA and by higher taxes because you did so well saving. Another component in the TSP, they do Roth TSP as well. You can elect that. Just a lot of people don't do it because they don't want the withholding, right, to pay the taxes now. So there is some smart planning you can do up front. I would say, is that a landmine, right? How much time do you got to put in? If you're buying your military time back, what you're doing for your job to really understand how the pension works, number one, right? And then number two, what type of account is it? We were talking about that before. Where do you want to be more aggressive in your Roth, right? Taxable or your IRA, but also what type of money it is that you're allocated into if you need to be taking the withdrawals from the TSP. That's important.
Yeah.
Then overall the taxes, and this, unfortunately, federal employees, as they say, like the disclaimers, right? This is education. We can't give you advice. And so they have to get it from their HR, which can't give them advice. It's just very generalities. And these are the things that they're looking for, those specifics, being able to stitch that math together.
Yeah. Well, certainly I think as niche of a topic as it can be, there's certainly not a shortage of federal government employees out there. And, I think good planning always leads to better outcomes. I guess not always, but good planning tends to lead towards better outcomes. It's not too early to start getting some good advice from somebody that's looking at your situation, right? So appreciate the effort you're putting in and helping, our federal employees. I know a lot of it can be somewhat of a thankless job, whether it's the mail carrier or the person having to, keep the Social Security Administration running behind the scenes.
TSA, didn't get a paycheck for a little while here, just a little bit ago.
Yeah.
I'm part of an airport family, so I'd see that.
Yeah. So, hey, Trevor, if people have more questions for you, where's the easiest place to find you?
The easiest way to find me is on LinkedIn. It's my name, just Trevor, first name, last name, Trebbien, Trebbien. Look me up on LinkedIn.
Cool. Well, appreciate you taking the time, Trevor. And hey, everyone, we'll see you out there.
All right. Thank you, Brandon.